You're watching Econofen's smart insights that turn knowledge into opportunity. Today we're exposing the 12 Florida condo markets crashing so fast that some owners have lost over $200,000 in a single year. If you don't know which areas to avoid, you could be next. Here's what you'll get in the next few minutes. 1. The one luxury market where even million-dollar condos can't find buyers. 2. The shocking Miami stat: over 92% of sellers are taking less than asking right now. 3. The specific building where owners were hit with $160,000 special assessments per unit. 4. Why over 1,400 condo associations are on a financing blacklist that makes mortgages nearly impossible. 5. The 3 biggest red flags that scream "do not buy here." Let's dive into the worst performers first. Number 1. Crestview, Fort Walton Beach, Destin. Down 32% from $698,000 to $475,000. That's a $224,000 equity wipeout if you bought at the peak. Homes sit for months with no offers. Sales are down nearly 20% year over year. Pandemic-era overbuilding met the return-to-office reversal. Elevated mortgage rates and rising HOA fees. Too much supply. Too few buyers. Number 2. Sebastian, Vero Beach. Down 29.6% to $220,000, about a $93,000 hit near the top. Insurance premiums for individual units often run $5,000 to $7,000 a year, not counting the building's master policy. Tons of 30 to 50-year-old buildings now facing post-Surfside structural inspections. Deferred maintenance is surfacing, and special assessments are rolling in. Buyers see the risk and walk. Number 3. Homosassa Springs. Down 22.4% to $177,500. When medians fall under $180,000, you know something's wrong. Aging stock, limited liquidity, and a heavy retiree population on fixed incomes facing inspections, reserve requirements, and insurance spikes. Desperate sellers, thin demand, prices plunge. Number 4. Ocala. Down 19.6% to $181,000. Not even coastal yet still getting crushed. Slower economic growth, fewer young buyers, aging condos that need capital repairs. This isn't just about hurricanes, it's structural and statewide. Number 5. Tampa, St. Petersburg, Clearwater. Price drops from 5% to 15%, with St. Pete among the steepest at 12% to 15%. Inventory at 10.3 months, well above a buyer's market threshold. Sales off 20% to 35% depending on county. 2024's Hurricane Helene and Milton spiked insurance. About 78% of condos are 30+ years old. Inspections, reserves, and assessments are coming. Number 6. Cape Coral, Fort Myers. Condos down roughly 10% to around $235,000. About 8% of homeowners are underwater. Ian's 2022 devastation still lingers. Insurance doubled or tripled. Foreclosures rank among Florida's worst. Number 7. North Port, Sarasota, Bradenton. Down 17.8% to $300,000. Sales dropped hard. Inventory rose 10%. When supply climbs and buyers retreat, prices fall, simple as that. Number 8. Naples, Marco Island. Down 11.4% to $465,000. Inventory up over 200%. Sales down 21.7%. Million-dollar ultra-luxury is holding better, but mid-tier condos are cracking. HOA fees up nearly 10%. Special assessments $30,000 to over $100,000 per unit. Number 9. Orlando. About 84.8% of condos are selling below asking. Vacation rental oversupply meets return to office and buyers step back. Seller concessions everywhere. Number 10. Miami, Dade. Here's the stat: 92.5% of condos sell below asking, the highest in the nation. Sales down over 20%. Days on market doubled from 57 to over 100. Inventory at 14.1 months, more than double a balanced market. Nearly 700 buildings are on Fannie Mae's ineligible list. Only 0.9% of buildings have FHA approval. HOA fees rising 10% to 20% annually. About 85% of South Florida condos are 30+ years old. Number 11. Fort Lauderdale. Older 30+ year buildings average around $225,000 and trending down. More than 92% selling below asking. Submarkets seeing sales drop 25% or more. Number 12. The luxury market that can't move, million-dollar condos. Miami Beach and parts of the Biscayne corridor. Inventory is stacked, financing is tricky, carrying costs are exploding, and buyers have options. Even trophy towers are sitting, especially if buildings face insurance gaps, litigation, or unfinished inspections. Remember the $160,000 special assessment. That hit Murano at Portofino in Miami Beach, some units even higher. And it's not isolated. Similar 5- and 6-figure assessments are spreading across older coastal buildings. Why is this happening? 4 forces are crushing the condo market. 1. Post-Surfside regulations, mandatory structural inspections and fully funded reserves for 30-plus year buildings. Roughly 900,000 units affected, about 60% of Florida condos. Deferred maintenance is getting exposed and special assessments follow. 2. Insurance crisis. Unit policies often $5,000 to $10,000 plus on the coast. Master policies up as much as 400% in older buildings. Thousands of buildings underinsured or uninsurable. No insurance means no mortgages. 3. Inventory surge. Up roughly 65% statewide in Q3 2024. South Florida up 143%. A pandemic building boom colliding with owner panic exits. 4. Migration cooldown. Peak inflows around 318,000 in 2022 collapsed to about 63,000 by 2024, an 80% drop. Fewer out-of-state buyers, fewer Canadians and remote work reversals hit demand. The financing choke point. Over 1,400 Florida condo associations are on Fannie Mae's ineligible list for reasons like litigation, insufficient insurance, HOA delinquencies over 15%, too many investor units or failing certifications. If your building's on that list, conventional financing is nearly impossible. Buyer pool shrinks to cash only and values suffer. 3 red flags that scream do not buy here. 1. 30-plus-year-old buildings without completed inspections and reserve studies. The bill is coming, sometimes up to $160,000 per unit. 2. Buildings on Fannie's ineligible list or without FHA approval. No conventional financing means weak demand and poor resale. 3. Coastal buildings without clear affordable insurance documentation. If they can't bind coverage now, you won't later. What to do before you buy any Florida condo? Get the reserve study and latest inspection report, read them. Review 3 years of HOA meeting minutes for structural issues, insurance problems or assessment talk. Verify master and unit insurance coverage, carriers, exclusions and cost trajectories. Confirm financing with 2 lenders for that specific building and stack a backup plan. Calculate true carry cost, HOA plus insurance plus taxes plus a 20% buffer for assessments and hikes. Avoid HOAs that waived reserves, properties with pending assessments or buildings with 50% plus rentals. Where is the opportunity? Cash buyers who accept risk may find value at 30% discounts in buildings that have already taken their medicine, completed inspections, funded reserves, finished repairs. Newer buildings under 20 years push inspections a decade out. Inland properties often carry less insurance risk. But budget for 5 mice to 7-year holds and expect 10% to 20% annual increases in HOA and insurance. TD Economics projects trouble through late 2026. This may not be the bottom. Quick pause. If this is helping, hit like and subscribe. It really supports the channel and helps us keep producing deep dive analysis. Now let's look west to Texas. Texas, the real estate giant of the South, is showing cracks in 2025. Median prices fell about 3.2% year over year to roughly $331,000, still about $70,000 below the U.S. median. Austin leads declines at 6.4%, Dallas, 4.1%, San Antonio, 3.5%, Houston, 2.8%. Inventory surged 30.7% to more than 132,000 active listings. Days to close, about 105 longer than last year. The frenzy from 2020 to 2022, fueled by low taxes, cheap land and corporate relocations, has cooled. By 2024, supply doubled and bidding wars vanished. With mortgage rates hovering 6.8% to 7.2%, affordability became the ceiling. The psychology flipped in 2021, fear of missing out; in 2025, fear of overpaying. Sellers are covering closing costs, buying down rates, offering incentives. This is not a crash. Texas didn't overbuild like 2008 and population growth remains strong. It's a recalibration. Affordability is the pressure point. A $330,000 home at 3% cost about $1,400 a month in 2021. At 7% it's north of $2,600 before insurance or taxes. Middle-class buyers retreat. Sales are down roughly 1.5% statewide. Insurance is the second squeeze. Along the Gulf and in Houston, premiums are up 20% to 40%. That's an extra $200 to $300 a month for many buyers. Lenders want bigger escrows. Closings slow. Carriers pull back in flood zones. FEMA map tweaks can freeze neighborhoods overnight. Liquidity dries up. Deals still happen but crawl. Listings rose to 132,993, up 30.7%. Median days on market hit 105. Pause market is the vibe transactions but only after cuts and concession. A single Fed comment can stall activity statewide in hours. Storm warnings can trigger insurance moratoriums that halt closings. These micro freezes break momentum. Texas's growth model is feeling strain. No state income tax attracts newcomers but constrains infrastructure funding. Cities face zoning backlogs, staffing shortages, higher construction costs. Austin and Dallas see permit times double. Houston navigates flood rules and inspection bottlenecks. Friction equals delay. This is not one market, it's several. Austin is down 6.4%. Tech layoffs and luxury overbuild weigh. Dallas, Fort Worth is mixed. Some suburbs down 4%, others up modestly on corporate moves. San Antonio is off 3.5% as insurance and taxes blunt affordability. Houston is relatively stable. Energy jobs help, insurance hurts. Smaller cities, Waco, Tyler, College Station, show modest gains on remote work and retiree inflows. Bottom line for Texas 2025, redistribution, not collapse. Demand migrates from overheated cores to balance mid-size markets. Analysts see flat to slightly down prices into late 2025, then a rebound by mid-2026 if rates ease. Fundamentals, jobs, population, pro-business policy remain intact. Scoreboard median around $331,000. Inventory up 30.7%, 105 days to close. Sales down 1.5%. Strategy time. Buyers prep financing. Watch rates and negotiate. Concessions are back. Investors be selective. Cash flow first. Insurance diligence and realistic hold periods. Homeowners, this is normalization. Price discovery takes time. Avoid panic moves. Back to Florida. Knowledge protects you. Avoid older coastal condos without completed inspections. Funded reserves. Clean insurance and financeable status. Check the blacklist. Read the minutes. Verify insurance. Calculate true costs. Sometimes the best investment is the one you don't make. Subscribe for more data-driven real estate analysis. Comment which market you want us to dissect next. Thanks for watching EconoFin.